It feels like there's an app for literally everything these days, right? And investing is no exception. We've got these incredibly powerful tools right in our pockets, all promising to build our wealth with just a few taps. It's like, boom, you're just one download away from becoming some kind of Wall Street wizard. But is it really that simple?
So yeah, that's the big question we're really digging into. Can a piece of technology, all by itself, turn an ordinary person into a truly savvy, successful investor? Well, the answer, as you're about to see, is a lot more complex and, honestly, a lot more human than you might think.
All right, first things first, let's look at the tech that's spearheading this whole revolution. The promise behind robo-advisors is huge. We're talking about sophisticated investment strategies, things like automatic rebalancing and tax loss harvesting. They used to be just for the super wealthy, and now they're available to pretty much everyone.
So what are we really talking about when we say robo-advisor? Well, at its core, it's a smart algorithm. Its job is to take all the guesswork and, importantly, the high fees out of investing. It uses data to give you personalized financial advice and then manages your portfolio for you automatically. The whole goal is to make smart investing accessible, easy, and affordable. And look, it's an incredible tool, there's no doubt about it.
But here's where the plot thickens. You see, having a powerful tool is one thing, but knowing how to use it, or maybe more importantly, having the right mindset to use it well, that's a whole different ballgame. This is what a lot of researchers call the knowledge-action gap.
And this is the reality check. A recent study that looked at this very question found something, well, kind of startling. It turns out that simply using a robo-advisor doesn't, on its own, lead to better, more disciplined investment habits. It seems the machine can't actually do all the heavy lifting for us.
Now take a look at this. The data from that study is pretty striking. It shows that financial literacy, your actual understanding of how money and markets work, is a huge predictor of good investment habits. But just using a robo-advisor, turns out it had no statistically significant effect. The key takeaway here is pretty clear. The tool just can't replace the knowledge in your head.
This isn't exactly a new problem. The legendary investor Sir John Templeton was warning us about this stuff decades ago. He totally got that the biggest risks in investing aren't really in the market. They're staring back at you in the mirror. It's all behavioral. Things like panic, greed, and just refusing to learn from the past, those are timeless traps.
So if the machine isn't the secret sauce, then what is? Well, for that, we can turn to the wisdom of Sir John Templeton himself. His incredible success wasn't built on fancy algorithms or complicated models. It was built on something much, much more fundamental.
He was convinced that real success in investing comes down to character. Things like self-reliance and patience were huge for him. But the big one, above all else, was self-discipline. That ability to control your own emotions when everyone else around you is completely losing their cool. This wasn't about being a financial genius, it was about mastering yourself.
And this idea of character wasn't just some abstract concept. For him, it translated directly into a set of timeless, practical rules that really any of us can follow today.
Let's break this down. It all kicks off with a learning attitude. That just means you can't be afraid to make mistakes, because you will, as long as you actually learn something from them. From there, it's all about doing your own homework, not just blindly following the latest hot tip. And then, when things get shaky, it's about having the right mindset to keep your panic in check. And finally, you can't just set it and forget it. You've got to stay engaged and keep an eye on your investments.
And all of this brings us right to the heart of what we're talking about today. We really need to shift our thinking from being just a user of technology to becoming a true investor in our mindset.
What's really fascinating is that the latest research in financial tech is finally catching up to what Templeton was saying all those years ago. That paper we mentioned earlier? It concludes that for robo-advisors to really work, they need to build in what they call behavioral reinforcement. We're talking about little nudges and bits of feedback that help us develop that exact discipline Templeton championed. So, for example, maybe an app could remind you of your long-term goals during a market downturn, helping you fight that urge to panic and sell.
And this really lays out the difference perfectly. A tool user is passive. They just react to whatever the market is doing and follow alerts without thinking. But an investor, they're active. They do their homework, they work on their discipline, they control their emotions, and they use the tool as just one part of a bigger, smarter strategy. So you got to ask yourself, which one are you?
So here's the bottom line. The answer isn't man versus machine. It's man with machine. We should absolutely 100% be using these incredible new tools for their speed, their data, their low costs, but we have to be the ones in the driver's seat. We have to be the ones guiding the machine, using those timeless principles of a disciplined, patient, and knowledgeable human mind.
And that really leaves us with one final, and I think critical, question you need to ask yourself. As you make your way through this world of modern finance, are your tools shaping you? Are they causing you to react emotionally, to be impulsive? Or are you taking control, mastering those tools, and shaping